All right. If you're at the bar and talking, you're not being respectful. We got to move this along. Marin, Jeff, guys, we're starting.
Thank you.
If you're at the bar and being quiet, you're respectful. All right. We're running slightly behind on the lunch. Scratch my head. So we're here to talk about how we navigate the investment markets. Patricia, are you ready for this? To navigate asset classes, regions, industries, and then a lot of us are focused on philanthropy or next gens or impact. But we're here to, we are at war. Biden just stepped down minutes ago. Someone wanted volatility again. We have really great people. One person's on Zoom. We have Barbara, who you might recognize from CNBC every week. Pat, you may remember from our sessions before. We met 2 years ago, in fact. There was ping pong around us, if I remember, or that was post ping pong.
Yeah, not pickleball.
Not pickleball, but ping pong. But listen, we got a few other people. I don't know where Mary is, and Bill is on an airplane. So let's just start off. We're going to let everybody talk about what scares and excites them. And if you're our wait staff, I get it. They're going to be noisy, but I like to start off with Sridhar. Sridhar, can you hear us? Yeah. Sridhar? Okay. I know you've been around the world. You've worked for big groups like JP Morgan. You and I were having lunch this past week or last week. And I said, well, what would you do with 10 million, 100 million, $1 billion? Where would you put it in the world? And that sort of is a reflection of what scares and excites you in the world. So do you want to just introduce yourself and answer that question for this group?
Great. Thank you so much, Mark. Nice to meet you all. Happy to be here. And I think it's a great question, which Mark has framed. If I had 10 million or 100 million, where would I put the money? We do play in, I'm a banker, economist, as Mark put it. I'm ex-JP Morgan, Citibank, Wells, Goldman, and now we run our own private market funds. I think my son is always sitting amongst you. So we play both in global, we play both in public as well as in private markets. The focus of my kind of observation, as Mark framed the question, is more around the public markets, equities. If I had to do an allocation, I'm always a 80-20, 80 equities and 20 fixed income, and that's purely fixed income just as a hedge, but otherwise I'm a pure play equities player around the world. We operate globally, and the most attractive market for us is United States. There's no there should be no surprise. So if I had 100 million, 70% of my capital would be allocated to the US markets. Then I look at the balance 30%, and then I try to assess, where the opportunities are, both within the context of the rising GDP, plus as well as the growing market capitalization adjacent to that. 4 or 5 markets where we have invested is where we found opportunities and success, especially in the last 2 years, and going forward, I think we will probably follow the same pattern. I would probably put somewhere the balance of the 30 between 10 to 15%. I like Japan. Japan is really getting its act together in terms of the corporate governance, transparency, much more around the traditional kind of models in terms of transparency around their balance sheets, and also they're getting their economic policy right from the central Bank of Japan point of view. So we have had good success in the Japanese market, so I think I'll continue to put money in the Japanese market. Then I think that I look at two other markets opportunistically, and then before I kind of wrap up on the last one, surprise, I mean, I don't know how many people put money in Taiwan. We do put money in the Taiwanese market. We like semiconductors, we also like AI, we also like microelectronics, and Taiwan is a power hub where we have again seen 15 to 20% IRR over the last 2 years. We're not concerned about the geopolitical risk. If I have to put money, I'll continue to put money in the next kind of couple of years. The other market that we have dabbled in and we have found success, but it has to be done very carefully, is India. India today is the fourth largest by market cap, and I think it will soon displace Japan to be the third largest equities market following US and China. There's a lot of money flowing into India, not only because of the GDP growth. India trades on a nominal basis is around $4 trillion, and I think it's very clear it is making its way towards doubling that in the next 4 years. So there's going to be natural kind of harmony and propensity in terms of the companies translating into growth in the corporations that drive and participate in that growth. And we never leave Europe. In Europe, I'm excluding UK here. We look at very closely both Germany and France. So that's where I would distribute my 30% between Japan, Tokyo, between Japan, Taiwan, India, probably France, and Germany. We exclude opportunistic markets. There are quite a few markets in Africa as well as Latin America which are attractive, but we somehow we have opportunities in markets where we have knowledge as well as ability to balance capital should markets go the opposite way.
So Sridhar, you mentioned Taiwan. Are you at all? How do you see the prospects of a China-Taiwan conflict, broadly spoken?
Well, I think that we have factored in the China-Taiwan conflict. There's a very good kind of benchmark. If you look at the Hong Kong market, which transitioned and Hong Kong has faced its own challenges, and China has quite brutally integrated Hong Kong into the market. The Chinese market, mainland Chinese market, has suffered, but the Hong Kong market has seen at least a tepid growth. So we don't believe even under the very aggressive circumstances, China would do anything silly that is going to upset many of the industries which China is reliant on, as well as the opportunities that the China sees. So it probably would be, the risk will be considerably mitigated by the way Chinese will deal with Taiwan, is the way we look at it, Mark.
So just so everyone knows, if you go to our content sites like YouTube/361 Firm, you type Taiwan, and you'll see how the name pops up. We've done a China-Taiwan conflict discussion. We did one 2 weeks ago. In fact, we did a breakout. We did geopolitics and trade flows. Actually, Stephen Burke is supposed to be on this. Where's Tom? Is he on? Or have I not let him in? So Stephen kicked off how basically how the trade flows were in blocks, clearly, and then some overlaps. But also we talked about geopolitics and dual-use investing. I mean, 5 years ago, everything was fintech. Now everything's dual use. And we talked about Asia, to say China, Taiwan, Asia. We talked about Iran. And we talked about Russia, Ukraine, and I spent 8 years in Russia. So it just boggles me that I was on the board of Ernst & Young for the CIS, sitting in board meetings in Kiev with everybody's friends. And now that they're all Facebook friends, but they don't talk about the war. And it's just, but this is, I think the world is waking up. There's some interesting companies that are helping Europe, like retool, weapons rise. Anyway, these three conflicts, geopolitics is a factor, and Sridhar, thank you for joining that, and you'll be back to talk about this theme of geopolitics, but let me move on to asset classes. And I don't know if I should start with Barbara or this feels like you could wax
on. Yeah, whoever you want.
I just have to stay away from you.
Are we waiting for Stephen? Is Stephen going to try to get on?
I'll check it. I'll turn my camera. Yeah, but you go anyways.
Okay. Alrighty. I'm Barb Duran. I have my own investment management firm, Wealth Advisory, and I'm also on the Investment Council of Penn State. So I wear two very different investment hats. But I'm going to talk a little bit about the U.S. equity markets because that's really is my specialty. Although I can't disagree with his, most of the markets, the developed country markets around the world, Japan, emerging India, and European markets have been very strong this year. But of course, the U.S. has been leading a pack. And I think for reasons we're all pretty well aware of at this point. I mean, the market came into this year expecting the Fed or hoping the Fed would cut some 6 to 7 times. Of course, that number and the timing has been reduced numerous times, and yet the market's powered higher. And I think a big reason for that is earnings. Earnings troughed in the third quarter of last year. They have continued to improve. So the quarterly earnings, which just began last week with the big banks, are expected to come anywhere 11.5% to 13%, which would be great. And forward earnings guidance so far is positive, but we're still early. I think only about 15% of companies has reported. The question right now, we started to see a bit of a pullback. We're all familiar with the Magnificent Seven and what a huge percentage they are of the S&P.
Sarah?
Of the S&P 500, and also, do you need me to stop for a sec? Okay. And so it's been a question, without the market broadening out, how long can this be sustained? Well, the fact is, even if you look at Microsoft, Meta, any of these names which have had great runs, they're still not all that expensive historically. They are at the higher end of their valuations, but they're not extreme. And the fact is it's underpinned by real earnings growth. And names like NVIDIA, which are all very well aware of, reports at the end of May probably blows away the numbers yet again. So a lot of these growth names will continue to have earnings and they will grow into their multiples. At the same time, we now, for the first time, seem to have a real idea of the timing of the first Fed cut. If you look at the Fed fund futures right now, you've got almost 100% probability in September and also in November and December. And that changes things because then it can be, is this about market rotation? Can the market now broaden out in a sustainable way? And we've seen a lot of false starts over the last year. And small cap is one of them. And that had a huge run in the last week, up 11%. Question is that sustainable? Probably is if the Fed is going to be cutting. And certainly the Fed has been setting the table the last few weeks. Chair Powell's comments, hey, we don't need to get to 2% inflation. And you know what's been happening with inflation in the last few months. And they're getting very close to feeling confident that inflation will continue down. So, and Chair Powell also has made a point to say the Fed is independent of politics, which to me says we might do it in September, and we don't want to be accused. Well, they're now, as you just heard, there is no incumbent president running, so I think the heat would be off the Fed in that regard. So I think that, the market, we're still setting up, we're in a bull market, could be a very long bull market, and it's a question of, where you go now. I think any pullback, on some of these big cap names, you can get back in. The rotation small cap is still, undervalued, and typically when interest rates come down, small cap does better because their cost of capital tends to be high, with I think something like 40% of their debt in variable debt. So I think we remain very constructive on the U.S. equity market, and and what we've also seen in terms of growth slowing down, and you've heard Chair Powell say for the first time. Well, not first time, but really changing his emphasis that they are now concerned that they may slow too much. And that's important, and that means some Fed cuts coming. And we have to see how many and when, but I think it's soon. And that's a good underpinning for the market. So I think the U.S. stock market should be good for foreseeable future, meaning the next 6 to 12 months. So I'm happy to take any questions later if you or want to talk offline. Happy to.
Lots of questions. We will have lots of questions. Yes, Pat, over to you.
All right, thank you. So had a quick connection in Tampa, so I'm very happy that I was able to make the conference and be up here with you guys. So on the public pension side, the one thing that I love, and I know most of the folks in this room on the allocator side are from family offices. What I love about family offices is that you can allocate your money however you want to. I can't do that, on the public pension side. So I've got a bunch of rules that I've got to follow. One of those rules is in, our investment policy statements. Most public pensions have things that go into allocation percentages. And what I heard from a lot of trustees, from mid-size to large pension funds, and in our world, mid-size is about between the 5 to 20 billion range, and then large is anything above that. In 2022, those pensions that had pretty heavy private market exposure, they did very well on a market basis, but their public market allocations did very poorly. So what that did is that forced rebalancing that occurred based on their investment policy statements, which mean they had to sell a lot of those private market investments that really shouldn't be sold on the secondary market. So they didn't realize those market gains because they were getting secondary prices. And that soured a lot of those investors in the pension world. And I know in the family office world, you don't have to deal with that because, and again, I'm a government employee. I hope we're not recording this, but we're talking about a government bureaucracy that just doesn't make sense. A venture investment should not have to be rebalanced in a year and a half or 2 years just because it represents a portion of the portfolio that's 3 or 4% too high. But that's what we have to do. So one of the things that I'm seeing in 2023 especially is in the amount of time that I have been in the public pension world, and probably should have introduced myself for those who don't know me. I chair the Tampa and Fire Police Pension Fund. It's a $3 billion fund down in Florida. Other than the Florida retirement system, the state fund, we are the highest AUM municipal pension fund in Florida. So one of the issues that we have is that investment policy statement and how it's just not nimble. Like everything else with government's, a large cruise ship, and it takes a long time to be able to direct that ship in a different direction. So as the investment markets change, as the public and the private markets change, and proper allocations for returns and everything change, we can't be as nimble as a lot of you folks who have family offices. And that is why public pensions in general are not as successful in the long term as a lot of the best family offices have been. But one of the things that I'll say is that in the years that I've been here, in the years that I've been in the public pension world, everything that's jammed down our throats in our pension conferences has been, you guys need to lower your discount rate. You need to lower your actuarial assumed rate of return. And we have a lot of funds that are 5.5%, 6% discount rates. And for the first time with bond rates and coupon rates as we're seeing them now, I'm starting to go to conferences and I'm hearing actuaries say, hey, you guys need to raise your discount rates. And one of the things that happened after the financial crisis was when fixed income, and typically public pensions were 60-40 or 65-35, public equities and public debt. There wasn't a lot of alternative exposure in the pension world. You had your big pensions in California, you have your Canadian pensions who really explored that, but most of your municipal and state U.S. pensions, they were strictly public markets. After the financial crisis, and pensions realized, hey, we need a way to realize, we need to realize alpha, and we're not going to get alpha in the bond markets because the rates are non-existent. you started to see more go into private equity, private credit, venture, things of that nature that are really there to generate alpha. So I see in the next year or two, I see a lot of public pensions potentially coming out of the private markets and going back into public debt when you start to see coupon rates that are more attractive to what they were, before the financial crisis, when you had more public pensions in just equity and fixed income markets. I don't think that's a great thing. I think that the private markets are a place for a certain percentage of assets in any public pension. But the problem is, and the problem that has to be addressed by the policymakers is, we need to make sure that we don't impact these allocation decisions and just based upon unnecessary rebalancing. There needs to be some sort of an understanding that a private equity investment, a venture investment, even a private credit investment is a long-term investment. And the percentages may vary year to year based on a market value, but we need to stay for the long term, like all the family offices do. And that's a policy decision, and unfortunately there are a lot of smaller public funds. They just can't really get into the private markets. For them it's cost prohibitive, or they don't really have access to the best deals. But I think that's something that I'm seeing with talking to a lot of other trustees, is more of a focus on the public markets. Public equities, like was said, I do hope the Fed cuts rates in September, because I think that's already priced into the market, and if they don't cut rates, we're going to definitely see a correction. But I am seeing a lot more interest in public debt, in not necessarily junk bonds, but even any kind of investment grade corporates. I'm seeing a lot more interest in other public pensions than I've seen really in the past 8 years I've been doing this.
Shall I start? Hi, I'm Mary D'Souza. I run a single family office, Misha Investments. I had a quick question for you. What is the discount rate that people say you should be looking at?
So I've been told that ours is very high, and it is very high in the public pension world at 8%. We used to be at 10%, and we went down to 8%, even though over the past 10 years, our average annual return has been about 9%. We're a little bit lower just because we want to be a little bit more mainstream. But again, the kind of the general consensus in quotation marks is probably about 6.5%.
That's interesting, because just like in 2016 when interest rates, 2016, 2020 when interest rates were nothing, the discount rate was like 5% for some. So that's why I asked you the question, because I thought it was really interesting to see where you fell in terms of the spectrum. So you're absolutely right. In terms of family offices, we do have a lot more discretion, and we can pivot, into public and private. And what really scares me is what you said about, selling private investments right now, and in 2 years piling into the public markets, because I think it'll be too late. I used to work for a very large firm, and the very first thing they wanted me to do was do a secondary sale of our private equity funds. This was like in 2000. And I was like, you should be buying more of the funds that you really like instead of doing a secondary sale, right? What we are finding is, we do have a lot of allocation to public markets, so we have done extremely well in the last 12 months. We still stay in the private markets, because when everybody wants to sell, that's when you have the opportunities, and we see the opportunities in the secondaries fund, whether it's secondaries private credit or whether it's secondaries, private equity or VC. So we see the opportunities over there. And even on the real estate side, when it comes to bridge lending, you're high up in the capital structure and you still get a good return. So we play in that area, and we have some exposure to India, and we're looking at a little bit of Africa. And we do have a couple of operating companies, so we focus on building our operating companies, because there we think we can create the maximum wealth and value. in terms of interest rates, it was really interesting to see what you had to say in terms of interest rates. I really think they need to cut because I'm on a couple of boards. One's a trucking company, and the reason why it was a buyout was because it's an agricultural trucking company and it's supposed to be very stable. It's not like the type of company where it goes, the rates go up really high when there's a supply-demand imbalance. You're supposed to have like pretty steady rates, but even they have had a little bit of a hiccup because small businesses are not doing well. And if you look at lower middle market funds, you can see what interest rates have done to small businesses. So I really think it's time for the Fed to cut. In closing, I would say in terms of family offices, I think we can be a little bit more patient and a little bit more thoughtful. And because we have the flexibility, we can take advantage of any kind of dislocations.
So give me an example of those dislocations you want to take advantage of, Mary.
So right now, pension funds and mostly pension funds, they have a higher exposure to private investments than they want to have. And so they have to sell when it's probably a really bad time to sell. So for us, it's a really good opportunity to invest in these secondary sales.
Let me chime in a little bit on that. And I've talked to a lot of CIOs from pension funds, and they're great people. They're very talented. They make probably 50% of what they could make being a CIO of a public pension fund than what they could make if they worked in the finance industry. So there's a lot of very good people in those positions who do it because they're dedicated, and I applaud those people. There's also people who do it because that's what they can do. They can't do that in the private industry. So when it comes to what we're talking about selling these private investments on the secondary market, the CIOs who are, in the bottom quartile, the bottom half, they're not selling the right ones. And a lot goes into why you're going to sell something on the secondary market, and a lot of these CIOs and these investment staffs, they just don't have the capacity to make the best decision possible. So there's a lot of wonderful opportunities on the secondary markets because of poor decisions being made by CIOs and investment teams.
Yeah, and I just want to mention on Penn State, we are not selling our private equity. We invest only in funds. We don't do direct investments. And if anything, when we need liquidity, when we do private equity or venture capital funds, those are our long-term capital that we're not going to need for another 5 to 10 years. And so we are just and continuing to add to that. And when we're adding venture capital funds, we are looking in the growth areas. Maybe somebody who's investing in AI and this kind of thing. So we're still moving. And if we need liquidity, we take it out of the public markets. So, but pretty much keeping the balances the same. But we are not moving out of illiquid investments at the moment.
What about we started off talking about the global allocation. What are your thoughts on, again, I give you 100 million, 100 billion, 3 billion. What do you give to other markets outside the U.S.?
I'll just be very quick for me, and I think one of the issues that a lot of public pensions have is policy-driven initiatives. I'm not even going to get into the whole ESG thing because that would be a whole hour. But you're going to start to see, and you've already started to see in some states, issues with China, issues with Taiwan. And for the most part, the government doesn't differentiate China and Taiwan. I think as far as the emerging markets go, India, which has been mentioned multiple times, that's a place to be right now. A lot of public pensions cannot invest in China even if we wanted to. In Florida, I am prohibited from having more than 15% of my portfolio in any foreign investment. And just because of that limitation, we tend to look at Europe. We tend to have a very, very small percentage in emerging markets, which we mainly allocate toward India, and the rest of that is in Europe. But if we had a larger pot of money to play with, then I would see a much more global allocation.
Yeah, and I just want to mention Penn State investments.
Can you stop mentioning Penn State for a second?
Hey, I have my Nittany Lion hat in the bag, so be careful.
Go blue.
No, but I'm just saying, because it's a $6 or $7 billion endowment. And in China, we just had this discussion at our last investment meeting. You know, what are we going to do about China? On a lot of metrics, things look cheap, different stocks. But we know what the issues are with their government and you know, how arbitrary things can be. So our attitude is, you know, we will hire managers in the area who do China as part of their mandate, but we leave it to them as stock pickers, you know, to do that. But we're always keeping an eye on that because we just don't think China is long-term that investable. I mean, you can trade it, but you can get your head handed to you. And so in international, we will always do some international allocation just for diversification sake, but in the public markets, it's U.S. is has the greatest percentage of allocation.
Does Penn State outsource its CIO function, or do you have it in-house?
It's a good question, you know, because there's different levels, like the Yales and the Harvards, you know, they have their own in-house staffs. They're huge because they can afford it. And there's other much smaller pensions that they may outsource that. We're big enough. We have a CIO, we have a staff, but that staff is not sourcing direct deals. We're not going to invest directly in equities and public markets. We're not going to do direct investments in private companies because we know our limits. We just don't have the money to hire that big a staff to do that level of due diligence. But no, we have a CIO, a very good one, actually.
And it wasn't asked, but I'll just go into it in case anybody's curious about mine. So we outsource our public equity and public debt markets to a firm that basically acts as an outsourced CIO. Everything else, we have a 3-person investment committee, which of course, I chair the entire fund. I also sit on the investment committee. That investment committee will source any sort of deal. So we don't use a CIO for that. We don't use a consultant for that. Most pensions, you know, large pensions are going to use a CIO. Smaller ones and mid-sized ones, for the most part, they have an outsourced consultant.
So do you guys use consultants like Mercer and Cambridge and
No, so we don't use consultants at all. I'm not a big fan of the consultant model, quite honestly. I think for them acting as gatekeepers, they like to source the deals they already know about and the deals that require them to use the less diligence. So what we will do with sourcing deals is if the investment committee feels that there's something pertinent, we will outsource the diligence portion of it ourselves to one of these diligence companies out there. But we do not use consultants because we don't feel that they necessarily always have the best interest of the investors at heart.
Other questions? Did you notice that Mary really wants to be a moderator? Because you usually are the... I know. Do you have any other questions, Mary?
Sorry, I'm so used to
No, I know, it's good. Any other questions? All right.
It's a question for Barbara and maybe Patrick as well. But I mean, Barbara, your comments were really focused on the public side. Can you speak a little bit about private credit, and likewise from the Florida side, a little bit of that flavor as well, for less liquid?
Right. No, I think on the private credit side, there's still lots of opportunities there for obvious reasons. In terms of the banks got out of that business a while ago, there's still demand, and you can still make nice returns, you know, high single digit or low double digit, depending who you invest with. So I know I'm the treasurer of the Explorers Club as well, the head of the finance and investment committees, and we do outsource our management. We use Neuberger Berman, and there we've said early on, but, you know, we hired them about a year and a half ago and said, private credit, find us a fund to be in that. And I still think that's there's opportunities there still. And so particularly depending how you want to compare it to, it's a good fixed income, you know, substitute in terms of the returns you can get if you're picking good funds. And there's lots to pick from. So we still see opportunity there.
Sorry.
Go ahead, Will. You want to go first? Or?
No, you.
Okay. Personally, I just like the private markets in general. I like private equity. I like private credit. If I didn't, I wouldn't be here. I think I really like CLOs. I mean, that's another animal, but that's a big fan of mine. I've got personal investments in CLOs as well. I think in the pension world, as we start to see better coupon rates on public debt, I see a lot of pension funds, the mid-sized to small pension funds focusing on that because the private markets are just complicated. Complicated compared to the public markets. And complexity, again, we're talking about government. We're talking about people who want to do the least amount of work possible. That's government, unfortunately. That's what most of these pension funds are going to do when you start to see better returns in the public debt markets. So I do like private credit. I think your more sophisticated pension funds, your billion-dollar plus funds are going to continue allocating more toward private credit. I don't see that being something that your smaller funds are going to be kind of pushed into.
So just to add to that, because I play a lot in the private credit space, I'm a strategic partner at one of the funds. The deal flow, in terms of supply-demand, there's more supply of funds this year than deal flow. I think interest rates have to come down a little bit for M&A activity to pick up, because what you're seeing a lot right now is dividend recaps, because sponsors have to, return capital back in order to raise their next funds. So if they have really nice, strong companies with cash flow, they don't want to sell the company yet. They want to do a dividend recap. So I think the market's going to get a little bit more competitive if interest rates don't start going down and we see a little bit more of M&A activity pick up.
Questions, others?
Good luck.
Mark, I have one more quick. I could
Scream it.
What about a VC, venture capital? As I'm seeing more institutions also lightening up towards that, fund funds or what have you.
I know what I will say about VC, and I've always loved VC as an investment category for a long time, as a good long-term, 10-year plus investment. I think what happened in 22 is anybody with a lot of Instagram followers and a good story was able to start a VC firm. And it is true.
That is true.
And because, everything was great, and the deal flow was great. And, I read now about the VC deal flow. I like VC as an investment category, but I think the most important thing at this point is to be able to realize the best firms. The firms that aren't going to be in that top quartile or so, I think they're going to go the way of the dinosaur here in the next couple of years. And the problem in other conferences I've been to, a lot of the VC firms that have been pushed, it's a lot of hype. It's a lot of, how much following the specific founder of the firm has and whatnot. Not necessarily what's this person's pedigree, what's the team's pedigree, what's the plan. So I think there's a lot of, I think there's just a lot of clutter in the VC world right now. And VC still is a wonderful investment, and it's a great category. Your Anderson Horowitzes of the world, your Sequoias of the world, they've pitched us. Of course, their terms are not as attractive as the terms of some of these other smaller firms. But, it's one of those things that you probably get what you pay for, especially in this day and age with the nature of the VC deal flow. So, I like the VC world. I just think we have to be very, very cognizant of who we're giving our money to.
Just as a related question, is the secondaries market, do you play VC in secondaries or across assets?
We do not. I don't know about anybody else, but no, we absolutely do not. For us to even enter the VC world markets, it's going to be a very, very specific, very pronounced diligence process. And at this point, we don't have any VC investments in my fund, although I do like the asset class. We just have not had the right one come across the table.
Gotcha, because a lot of pensions are recalibrating. I bet Penn State's going to come up.
Funny thing that.
Funny thing that.
No, I'm just saying what we're doing. And as I mentioned earlier, we're finding a lot of attractive opportunities in VC, and again, particularly in the tech space. We just allocated some new capital for a fund that has, oh my God, it's a who's who of Silicon Valley who are backing it, and they have track record with some 4 other funds, and they are looking in the AI space, and that there's so much to happen there that we can't even imagine yet. So we're seeing lots of opportunities, and we are committing capital.
Mary, another question?
Listen, I mean, if you're already an investor in a VC and you can pick up something at a discount of a VC that you really like, I think it's a great opportunity right now.
And not just VC.
Everything. Everything. I mean, if you know your asset classes and really well and you already have those investments in your portfolio, there's really great opportunities.
Other questions, points? Sridhar, are you still there? If you've been listening in, any other?
Yeah.
Anything you want to chime in? Yep. Just inviting you to add on, Sridhar, if you want. If not, we have another question.
Sorry, I missed the point. What's the, can you give me a little bit of the context so I can add on?
Just if you have any, what you've heard so far since you started the discussion, do you have any thing you want to react to or add on to?
No, I don't think, probably discuss more in the breakout. No,
Okay.
I don't have anything further to add on. Mark.
Okay, then Peter Saris has a question.
I just wanted to ask the panel if you follow the insurance industry now getting involved in direct deals themselves in terms of a new trend that they've been participating in. I understand the restrictions on the pension funds, but I'm wondering what your comments and thoughts are around the insurance industry now making direct investments, which is a new phenomenon that they've entered for growth because they've saturated their markets and looking for new growth areas.
I mean, the insurance industry has always, the top players, when you look at, say, a New York Life, a Manulife, they've always been direct players. They have such huge teams. They are some of the anchor investors in some of the funds, and they like to do deals directly so that they don't have to pay fees. So it's not a new phenomena. The smaller players can't do it because they don't have the team to do it. And then you have sovereign players that are beginning to do that too. There are some that are, that have been around for, like GIC, that has been doing it for a long time. But then you see somebody like a Mubadala. In the last few years, they've become really, really big as direct players.
Yeah, you mentioned some of the issues with the pension funds in general. Yeah, I mean, obviously those exist. I think it's an intriguing industry. Being from Florida, anything involving, disaster bonds, subrogation of insurance claims, I mean, to me, it's very, very risky. I don't think I would invest any of our fund's money into that. Personally, there's a lot of other private credit opportunities also that are interesting to me. Litigation financing is one example to me, it's just too much of a gamble with people's retirements. But they're very, very interesting investment vehicles. No? Okay.
Other questions?
I'll just ask a question to Patrick. It's the question you didn't want to get asked earlier, but just given that you're in Florida, comments on sort of the ESG side of your business and how the political landscape playing out down there and also nationally is impacting you, and also Barbara and Mary, feel free to comment as well.
The interesting thing to that is it's not really impacting, and I spoke at a 361 conference a couple years ago down in Miami about ESG, and the unfortunate thing about ESG is it's been politicized, especially with the G, the governance. You're an idiot if you don't look at governance before you make an investment. The E and the S, I mean, that's the more political part of it. But one of the things I'm seeing, other than in those blue states and those blue cities that really are always going to have that big focus on the ESG factors, I'm seeing a lot of those states that were just kind of on the fence about ESG, they're kind of abandoning it. And just in general from the pension world, 5 years ago, I couldn't go to a specific pension conference where every single panel wouldn't have something to do with ESG, and I'm not seeing that anymore. So I don't think ESG is being pushed on everybody's throat. The problem with that, I think it's unfortunate because the G aspect is so important in anything that you do. If a company is poorly governed, if an investment is just poorly designed, you shouldn't invest in it. And I think it's just been unfortunately politicized on both sides of the aisle, whether or not you're on the red side or the blue side. It's been politicized way too much, and that's unfortunate because what we need to be focused on for our members is what's going to guarantee them the income in retirement. And we've always done that. We've always looked at pecuniary factors only, without any other specific factors built in. But some of those specific factors that are always built in is the governance of the company, kind of some of the social aspects. We don't invest in gun stocks and tobacco stocks, not because we think cigarettes are evil and guns are evil. We just think there's too much regulatory risk and headline risk with those companies that they're just poor investments. So I think the whole focus on ESG has muddied the waters in what's a good investment and what's a bad investment. That's just my opinion.
Yeah, I would agree with that. Although in environmental issues, it's always good to have those numbers, particularly if you're looking at energy companies, oil, chemical, that have potential huge liabilities when something goes amiss or has been going amiss and gets found out, or whether it's asbestos or whatever it is in drug companies. So I think you do have to be aware, but in a way, ESG is branding, and you've got so many ways to measure it. If you look at any of your own brokerage accounts, you can usually find an ESG screen, and there's so many different screens. And it's a way of measuring, I think, management performance. So the environmental, you do, I think, depending on the company, have to pay attention to. But I think you're right on the governance. That's a big part, and that's part of being a good management.
I really think it has to be part of the way you look at deals. It should just be intrinsic, I mean, whether it's looking after your employees, your shareholders, the environment, all of that. I think those are companies that actually do really good business and just not putting an ESG label on stuff, because at the end of the day, if it's just superficial, it doesn't make any sense. But if it's just intrinsic to the way CEOs run their businesses, I think those are really well-run companies.
Jonathan, 1 second. And I put on here, we will be talking about some of these subjects, those are interested in climate tech. Like you.
Hello. So my question is your thoughts on the medium-term outlook for the U.S. dollar, U.S. inflation, and gold.
That's not me. So,
Well, I'll just talk about inflation. I mean, I think you've seen, all the recent economic data that's been coming in, whether it's jobless claims, continuing claims, which have been elevated and continue. I think we're in our 4th or 5th week. You look at wage growth is slowing. It's now growing. It's still going up, but it's at a slower pace than even pre-pandemic. You saw recent ISM manufacturing and ISM services data, weaker than expected. The only thing that was stronger than expected recently was retail sales, and that's really because a very flush consumer, still has savings higher than pre-pandemic. But you're seeing growth slowing, and that's been the inflation. And wages, was a big concern, and that's continuing to come down. And if you look at the JOLTS number, that's measuring the number of openings to work people looking, it's now back in balance, about 1-for-1, where it was really had exploded, many more openings than there were people to fill right after the pandemic, and that went on for the last couple of years. So you're seeing and part of the inflationary numbers, particularly when the CPI, has been housing, the rents. And rents people have been expecting month after month to start to see that show up on the CPI, because you're seeing the data that the rents are coming down. And that's a big part of it. And also, a funny thing was holding up was auto insurance, because there was a number of explanations, but people were having more accidents, post-pandemic, but also the cost of repairs was much, much higher and all that. But that should even out too. So we should start to see that in the numbers. So inflation should continue its steady descent. And if you look at the PCE, which, as you may know, is the Fed's favorite way to look at it, they look at the CPI and PPI, but the PCE is coming down. It's at 2.3%. So they're nearly there. And gold, gold is always an interesting one, like what makes gold go up, and it's usually fear, or flight to assets, or concerns about weakness in the dollar, or weakness here, or geopolitical concerns. And so,
on a related note, Wendy wants to know about Bitcoin.
Bitcoin, I still, I see it as a speculative asset. And it's been really, when risk on in the markets, Bitcoin goes up, risk off, it goes down. So I still don't see it as
She's shaking her head.
I know.
Oh, but the hand just shot up. Some people are talking their book here, because a lot of people in Bitcoin.
I mean, my question is Bitcoin right now is in puberty, right? It's 15 years old. You've got BlackRock, Fidelity doing the ETF. So did Hong Kong just launch one, Australia. What I believe, when you look at the dollar and you look at BRICS and everything, I believe Bitcoin itself will become a global currency. And as you see with Trump now discussing it and being part of the Nashville Bitcoin conference next week, he's clearly going to say that, because we want traceability and transparency. When you talk about, millennials, Gen Z, Alpha, they don't trust the banks. They don't trust the government. So this is the only decentralized currency. The rest of the other cryptos are centralized, but Bitcoin is truly going to become a global currency, I believe. And I think we all have to embrace it.
Just to add to that, and I agree with you to a very large extent. One of the issues kind of that I mentioned earlier with just government bureaucracy and incrementalism and failure to change, I could invest in Bitcoin in my pension if I wanted to because of the custody issues. A wallet does not meet the state of Florida's definition of proper custody. And yes, an ETF I could. But as far as direct investment in the tokens, I couldn't do it. And a lot of other pensions are in that same boat because the regulation has not kept up with the technology and the markets.
So, I mean, it's like something that, at least us, like 2%, like what you typically pay in advisory fees, that's something you could easily put in, and it's a volatile thing. So at the end of the day, you only put capital that you can afford to lose, and you can sleep on.
So as we end this, we'll be here next year. I don't know if we're here, or we'll be somewhere next year. A prediction.
We're talking about a year from now in the stock market. I think we'll be higher. I think rates will continue to come down because we are concerned about slowing. And in fact, who knows, with the lagged effect, it could be a lot more of a slowdown, and that could start to be a worry in the market. But I think if Fed continues to cut rates once they start, it's going to be obviously positive for the market. And also, I want to mention the AI. We haven't yet seen the productivity increases that will come from that, and they're going to be huge. And that is still unfolding.
Fair enough.
I think I tend to agree with the sentiments in terms of where the markets would be 12 months from today. You're seeing consistent growth by virtue of interest rate reductions in Europe, Japan reorchestrating itself, and US. I would expect anything between 20 to 30% growth in the markets, particularly the developed markets, on the equity side. On the Bitcoin side, I think that there was a very good observation made. I think Bitcoin and crypto is here to stay. Whether it is a tradable currency or whether it is just a currency where 3 to 5% of allocation happens in the alternate as part of the alternate assets. That will continue to grow. There's some widely speculative predictions. I don't expect this to be a $7 trillion market as somebody had predicted next year. But we'll be somewhere close to, I would say, between $3.5 to $4 trillion in terms of the crypto market cap next year.
Okay. I think we're going to be slightly higher in the public markets next year. I think we're going to continue this upward momentum until the election, like we do with pretty much every election year. Doesn't matter who wins. Election years tend to be up years. I think a lot of it does have to do with what happens in November. Are we going to have a divided Congress and White House, or are we going to have one party in power? And that could really affect, doesn't really matter who it is, but the markets don't necessarily like a lot of radical change. They like that stalemate, they like that stagnation. So I think we're going to have a upswing. I think we're going to have a correction. I think probably this time next year the public markets will be slightly higher than what they are now. I think the deal flow is going to get better, and the private markets are going to be a little bit better than what they are now, especially the PE and the VC markets.
Meaning valuations?
Yeah, I think the valuations are going to be a little bit higher, and I think there's going to be a lot more deals being made.
Okay.
And I agree with everything that they're saying. What I'll add is I think the IPO market will open up, and you'll have a lot more M&A transactions.
Well, that would go part and parcel. All right. Well, great panel. Appreciate your time, everybody. Thanks, Sridhar, as well.
Very hopefully Mark next time I'll be in person.
Sorry?
Person next time?
Yes.
My apologies.
Well, you won't have an injury next time. So if Jack could come up along with Jane and I guess Patricia or Shahid. Of course, there she is. She got her coffee. Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.